back to why we do this. Investment is war. We are at war.
Yes.
We have unleashed our money into economies. We've unleashed our money into companies. Government is announcing directives which are affecting the value of our portfolios. Everything is chaotic, and we can no longer figure out what the value of our wealth has shrunk significantly in the last couple of weeks. So it's such an interesting time for investors. What should be the mindset of an investor now? Should it be one of protecting value, or should it be one of profiting from the low valuations? These are two different mindsets.
Yes.
Yeah.
I think as an answer that is also to just realize that everything that goes down must come back, and vice versa. Anything that goes up will come down. I think now we've seen most of our stocks at almost bottom lows we've never seen in decades. Yeah, I think even the rate cap of 2016, we did not see lows we are seeing right now. You know.
But we've also never been here before.
We've also never been here before,
exactly.
or not to the magnitude that now we are in. You know, we've had other pandemics. You know, the HIV and AIDS was dealt with, the SARS, the MERS, and all these flus that we've had. But it has never become so evident in Africa as it is right now.
This is worse than the global financial crisis.
By far. I think even the
at least we knew what had caused financial
crisis.
Yes,
we knew the problem, the chaos.
This one
and all
is an invisible enemy.
Correct. As we started, it's a proper war we are in, where you cannot see the enemy. The bullet could come from anywhere. You understand? And could take you out. So it's about how you hide and how you just try and live, basically. It's
survival.
To try survival. It's to try and outlive this. It's either it takes you out or you outlive it. You have a clear option. I think for investors right now, again, working as we agreed earlier on, is we are all working on scenarios and stress testing them. So any scenario would have it is out stress tested for 1.5 years. We've already seen a couple of, especially the local investors, buying because of the valuations, which are making sense. But I think right now they've realized no, it's not about the valuations anymore. There are bigger things beyond valuations, beyond technicals, beyond any financial
even
reason.
The companies they're buying, they don't care about profits.
Correct. So right now it's about
survival.
It's about survival. And for your portfolio, it's also to ensure they survive this. And how do they survive this? Is, of course, just make sure you're just diversified, because you're already invested. You're well diversified. I think it has taught us on stop losses and how to do that. I think that's one thing especially locals had not taken on, because you're not, again, as technical as the Western world. As is always a decision, you come to a boardroom and make a decision, do we sell? It's already too late by the time you're doing that, before you're getting quorum, it's already too late. In the US, it's not they've removed the human aspect from investing, It's a system. There's no thinking, Safari. No. It gets to a certain level, they exit. It triggers the exit. It triggers the buy. It's already automated. So they're removing the human aspect, the emotion out of the investment. Because remember, again, it's a learning environment for all of us. And I think now any new monies that they might be getting as an investor, any new monies you're getting, especially for you people on the buy side, is to again work with that time frame and stress test it for that time. Because we've agreed, this thing, we are going to outlive it. I think there's that general consensus that we're going to outlive it. It is not going to wipe us out. It's just a question of when. We already have the worst case time scenario, that's 1.5 years. So again, preparing for pleasant surprises.
Could even be worse.
Could even be worse, yes. Or we could get a cure tomorrow, you know. So again, those pleasant surprises. So of course, for our portfolios, we don't plan for tomorrow. We plan based on official guidance. And that could take 1.5 years, you know. So any new monies you're getting right now is just, of course, right now it's about averaging. It's about making sure you're properly hedged, making sure you're properly diversified, making sure, because should this rebound, then you might have a very tough time trying to catch the markets, And the question you're going to be asked is, Safaricom go to 20, what did you do?
I understand, and I think for me it's again, there has to be one primary mindset. The primary mindset is one, we've spoken a lot about survival, which naturally leads us, we need to be protecting value.
Correct.
Protect value as much as possible. So just like a central bank, which has monetary policy tools, interest rates and the other stuff that they use to control the environment, an investment manager has asset classes. You have cash, you have equities, you have fixed income.
And now derivatives.
And you, of course, have some derivatives. What should be your primary, what should you hide in these times? Where should you be?
I think for local investors, it's quite obvious. You might support me in this. I think most of them run to fixed income, yeah, because of the safety
Which
element
is
of
also
it.
not.
Yeah, it's
that might change too.
It's not bulletproof as well.
Interest rates are likely to go up.
They're likely to go up, and also should your government can go bust as well, yeah.
And government can also go broke.
Yeah, it can go broke. So again,
very likely scenario.
Very likely scenario right now, especially.
Right now.
Yeah, before it was almost unthinkable because it was thought of, okay, before the government goes broke, your equities will have already gone broke and bust, yeah.
Yes.
So I think we've seen scenarios where it's almost been 65, 35 or 60, 40 and, in favor of fixed income and the rest for equities. But I think at the current valuations, I think we've already agreed we are defeating this. Yeah. So at the current valuations, I would actually put my weighting, and again, I stand to be corrected, but I'll skew my portfolio more to the equities. I see more upside in that than we see in the fixed income, especially now they're talking about rates. Yeah.
What if the valuation of KCB comes to 25, justified, given the
environment?
The environment.
Yeah.
NPLs have shot up. No new loans. Government putting pressure. So
at the same magnitude, the government.
Are we likely to enter into a trap where we are anchoring on a mindset that was relevant in the previous
yes.
in a season that is already past us, or we are past that particular season, and therefore making the wrong decisions for this particular environment.
In this environment, and you have a fair point in that.
Yes.
But I think, and I strongly believe, with the magnitude the government will be pushing, especially say the banks, to support them in this initiative, is the same magnitude the government will come to support them to now bring them, buffer them back up to the levels they were. So especially we're talking about, we'll see so much of government interventions in the companies that we are investing in. It's not about help us when you are in problems. When the problem goes away, now you go sort yourself out. I don't foresee such a scenario. I think it's utmost good faith. You helped us. And
it's
now
survival.
Yes, it's survival. You helped us. Now the banks should do this, and you're talking about NPLs of 40%, because the bank has to, the government has to come in, the sovereign has to come in and help. Now it's them to survive.
The might be broke.
Yes, to help the. Remember, they have so many tools. Once we do away with this, they can even lend. They can even borrow to just support these key industries. Because then again, you deal with COVID, now you start talking about an internal recession.